Look at the CREs, the commercial real estate. The trouble is that if you've got nobody staying in these tower blocks and the debt costs, the financing costs have shot up, you just want to get rid of it. I mean, they're valueless, which has implications because that wipes out, I think, slightly over half the total equity in the US banking system. And that's just one aspect of lending.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for March 4th through March 11th, 2024, while supplies last. First, we feature backdated 1-ounce silver maples at $3.39 over spot. We also have circulated British gold Queen Elizabeth sovereigns at $26.99 over melt. And finally, we're offering our choice 1-ounce Palladium bars at just $119 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always privileged to have this distinguished returning guest, Alasdair Macleod, a former bank director and the head of research at goldmoney.com, as well as the founder of Macleod Economics, joins us this Tuesday, March 5th, 2024. Alasdair, thank you for coming back on Liberty and Finance.
That's my pleasure, DK.
We always tap your knowledge base because you have a deep and extensive history in the banking industry and the bullion industry and an eye for geopolitics and the effects on our financial lives. We're grateful for all of that. Right now, if we could start off today where gold has hit a new all-time high, closing at an all-time weekly close on Friday against the US dollar and breaking up above the significant $2,100 resistance level that has now looked like it may be forming a support level for gold. And many people are saying that the fundamentals are in place to support an extended bull market in gold and other precious metals. A lot of emerging attention, which we predictably anticipated over the years of being the lonely ones talking about the virtues of owning real assets and the necessity of protecting oneself against the destruction of the fiat currency system and the fragility in the banking system and the bubble of everything in the stocks and bonds and real estate. For the longest time, gold was either being roundly criticized or frankly ignored by the mainstream financial press and officialdom. Now, suddenly today, I have multiple clients calling me and saying that their family members, high-level investment advisors are now saying, hey, you should look at gold because gold's on the move. So that is almost humorous to those of us who have been holding on to such a, I guess, well-grounded but unpopular attention span for so long about precious metals. Can you bring us up to date on what you're seeing right now in terms of this all-time high breakout for gold against the dollar and the perhaps renewed attention it may be garnering from the mainstream financial advisors?
Yeah, when you told me that, I was actually quite amused in a sense, because they're obviously just working off the charts. I mean, they haven't got a clue what they're talking about, which should be no surprise to us. It's been a fascinating market because what's driven it to new high levels is really central bank buying, demand from the Far East. I mean, China. Bear in mind that the Indian economy has been growing at an enormous clip. And of course, it's creating, ultra high net worth individuals. Now, do they import their gold into India? No, they managed to get resources outside India, outside any exchange controls. And I should think they're probably stashing their gold in places like Switzerland and maybe Singapore. The demand from Asia is only just really starting. And also driving the price is the weakness of the dollar. We're suddenly beginning to realize that the dollar has got a debt problem. We've seen, goodness knows how many people remarking that in the last 100 days, outstanding Treasury debt has increased by a complete $1 trillion. And people are beginning to realize that in this current financial year, you're probably looking at $3 trillion of new stock, plus about, I think it's 7.6 trillion of refinancing. Now, who's going to buy it? This is a problem. And of course, we've been talking about this for some time, but you can see how it's a situation which leads to loss of credibility in a fiat currency. It's actually as simple as that. It's not so much gold rising, it's the dollar going down. Now, most people would think, well, the dollar is actually pretty steady. The trade weighted is 103.4 or 6 or whatever it is. But we're not talking about the dollar against other fiat currencies. I mean, it is the king of fiat currencies. We're talking about the complete fiat currency cohort meeting a problem. Now, that 3 trillion of borrowing in this current fiscal year, which takes us up to September, assumes that the US economy isn't going to slip into recession. Well, I tell you, it's already in recession. The only reason that the GDP numbers look good is because of the money printing or the credit printing by the Fed. Well, yeah, by the Fed, if you like, and the US Treasury. The US Treasury is spending this money into GDP. It's not productive. So the idea that the economy is looking good is not at all true. And so I would be very, very surprised if the US economy doesn't actually go into a deep slump. So what does that do to the borrowing requirement? We're looking not at 3 trillion, but we're probably looking at somewhere 4.5 trillion. And then you look at interest rates. Are interest rates going to go down when all this funding has got to happen? No. And not only that, but banks are still running scared of lending to small and medium-sized businesses. And consequently, if there's a scarcity of credit, what happens? The price of it goes up. I mean, it's a no-brainer. It really is as simple as that. And then today we had the Bank of International Settlements came out with a warning that it looks like inflation is going to be around for a while. They made the point about enormous amount of debt that needs to be funded and all the rest of it. And consequently, they didn't see that interest rates were going to decline in the near future at all. So you can see there's a sort of awakening to this reality. And the interesting thing is that the Keynesians would suggest that under these circumstances, this is bad for gold because higher interest rates, means there's a cost penalty of holding gold. But that misses the point entirely. The whole point about holding gold is it's real money. Quieten down, Keynesians, please. It's real money, not credit. And you're measuring depreciating credit against real money. It's actually as simple as that. And none of the advisors who have spoken to your customers, clients, whatever, actually, I think, understand this point at all. I mean, they really don't. And the other thing is that these people are sort of thinking that gold is a pet rock. It's all, that was all yesterday's stuff. And because, this is propaganda, which has been put out since 1971 to try and establish the dollar's position as the reserve currency par excellence. And so now, there is a sort of growing realization, and has been for a few years, that the current fiat currency situation allows governments to print like Billio. Bitcoin came along, and that's now meant to be the alternative. But quite frankly, when you look at Bitcoin, what does it correlate to? Does it correlate with gold? No, but then hodlers would say, well, no, it's the new gold, so of course it's not going to correlate with gold. But I tell you what, I put together a chart which I think you've got a copy of. Basically, what I did was I put together 7 tech stocks, and it was the if you like, the monikers are down there on the bottom in the tech index, and I rebased it to 100 on the 24th of February 2020, which roughly is when the bull market, this current bull market phase, started, both for these tech stocks and also for Bitcoin. Now, Bitcoin is a red line, and you can see that up until, I think it was about October 21, there was a bull market in both. The correlation was perhaps not all that tight, but you can see that underlying bull market. And guess what? They turned at exactly the same time and then started going lower with a reasonably high level of correlation. And the bear phase then ended, and it then turned round a year and a bit later. I think it was October the 22nd, that second dotted line. And then we go into a new bull phase, and the correlation is there. And if you look at the correlation in the last few months, I mean, it's very, very tight. So what does that tell us? It tells us that Bitcoin is behaving like a tech stock. And what's been driving tech stocks? Well, tech stocks are in a bubble. I mean, I would contend they're in a bubble. And if you get higher interest rates, as I've just described, then tech stocks are going to crash. It's as simple as that. So where does that leave Bitcoin? Does it leave Bitcoin with this sort of wonderful idea that, because the dollar's going down and it's being printed in ever greater quantities, that, it's going to go to 1 million or whatever? I mean, this is what the hodlers tell us. No, it's a tech stock, for goodness sake. It's mirroring the bubble in the tech stocks. So when the tech stock bubble bursts, I think you'll find that everybody who's in Bitcoin, and this has incidentally been hastened by the new ETFs, Bitcoin ETFs, which allows hedge funds and managed funds, if you like, to speculate in Bitcoin, whereas before they had difficulty persuading their compliance officers that this was a good idea. Now, of course, they're listed. You can go in and you can buy the things, you can punt away. And my goodness, look at the volatility. Isn't it wonderful? I mean, if you look at it, it's just shot up from something like 200 in recent months on this scale up to close to 350. I mean, that's a tremendous move. Wonderful stuff. And if you can leverage it, so much the better. But all these bubbles do come to an end. And what this chart is telling us quite clearly is that Bitcoin is a tech bubble. It's as simple as that. So I've got more to say that in an article which I'm putting together for my Substack on Thursday. It'll be published on Thursday. So, those of you who have an interest in Bitcoin, I think it should be read. And incidentally, I have found that in the sort of Bitcoin community, there are some people who will not hear anything said bad about Bitcoin. They are so convinced that this is the new gold, if you like, the replacement for gold. They won't hear anything traducing Bitcoin. And that, I think, is dangerous. That is very, very dangerous. So I would ask people to have an open mind when they look at Bitcoin. I'm not predicting where the price is going to go. I would not do that at all. It's not my function. My function is purely to point out the relationships between one thing and another, and also draw to people's attention facts which they might not otherwise consider.
When you mentioned earlier the U.S. dollar, people not understanding how weak it really is because they say, well, look, it's holding up well against all the other global currencies. The image always comes to mind, and I don't know this, maybe as most metaphors are imperfect, but a ring of skydivers, the team of skydivers, they're all falling together, holding hands more or less, and then if they let go of each other's hands, then some of them will drift up a little bit higher, and some of them will appear to be drifting down lower. But the fact is that all of them are falling like rocks, and as opposed to standing on solid ground and holding its level the way precious metals or other commodities or other solid assets do versus real things. The other thing is a throwback when you mentioned about the Treasury and the Fed pumping out a new trillion every 100 days on average. The last 3 cycles, it was a 102-day cycle, then a 95-day cycle. Now we're heading for another about 100-day cycle for 1 trillion every 100 days. I don't know how many decades, perhaps centuries, it took for us as a country to reach their first trillion in debt. But to be doing it every 100 days now certainly appears to be a part of a death spiral of the monetary system. But what it reminded me of from my engineering career is a saying that in engineering and in manufacturing, what you measure gets done, and only what you measure gets done. So be careful what you measure. So if we're measuring GDP as the velocity or the amount of currency that seems to be in action or in play or whatever, then sure, the government can pump out more currency and say, look how the GDP has grown. That phenomenon, can you talk to us about how we've had John Williams from shadowstats.com on several times talking about the fudging of the consumer price index, the fudging of the unemployment numbers, the fudging of the GDP. How is it that this runaway debt, this exponentially increasing hockey stick of debt, $1 trillion of new debt every 100 days now, is artificially inflating what's the apparent GDP?
Well, it's quite simple, because when the government has a budget deficit, in effect, it is spending credit into the economy, which hasn't been taken out of the economy for it to spend. Now, what I mean by that is that if there was to be no effect on the purchasing power of the currency, then what you need to do is you need to get savers to save so that they can buy the debt. But if you look at the savings rate in America, it's actually continuing to fall. So what that means is that the spending in the economy by the government is not being matched by the withdrawal of spending by the by consumers, because savings are basically consumption deferred. That's what economists refer to it as. So if there's nobody deferring their consumption, all this extra credit is being pushed into the economy, then basically your nominal GDP increases accordingly. And GDP runs at something like, I can't remember the exact figures, it's in the order of about 30 trillion, 30 trillion. So if the government pushes in another 1 trillion on top, you're looking at something like 6% increase in GDP. And this spending really is spending. There is one aspect of this which perhaps we should take out, and that is the interest cost, because the interest cost doesn't go directly into GDP. That goes into the banking system. And some of that ends up being spent into the economy. So so what you can see is that even allowing for that, it artificially increases the GDP number. I mean, what the GDP is basically the total of the sum total of transactions in qualifying items. So, buying cars, buying, food, buying electronic goods, buying clothes, buying, all the normal stuff, if you like, which is in GDP. What the GDP measure is, it's the sum total of all those transactions. And it's seen by economists, if you like, as a measure of economic activity. This is actually incorrect. What it really does measure is the government's tax base. And that's why governments actually like it, because it's on the basis of these transactions that sales taxes can be levied. Income is another way, if you like, consumer income is one of the ways in which GDP is calculated. So that also gives you an indication of income tax and also corporate tax on Main Street, and so on and so forth. So it's a very, very good indicator for governments of tax. But what it does not tell you is the quality of goods being bought and sold with that credit. And so that's the way to look at it. That is why it's an entirely false figure. We shouldn't be looking at it in terms of, this is an indication of economic activity, because, the economy can be going to hell in a handcart, and GDP is still rising because the government is spending into, it's in effect, it's debasing the currency and juicing up the numbers as a consequence. That's really what happens. And I first noticed this many, many years ago. We had a chancellor called Gordon Brown, who subsequently became prime minister. When he was chancellor, He continually surprised the markets with the behavior of GDP, which was always slightly better than markets expected. But actually, when you looked at it, and I worked this one out, and nobody else seemed to be paying attention, it was quite simple. That extra performance was as a result of extra government spending. So, that's what it's about.
We've got a number of viewers' questions that have been submitted ahead of your arrival. If we could maybe just take a few minutes to hit a few of these in rapid fire with short answer format. If JP Morgan, the COMEX, and the LBMA have been manipulating metals pricing or availability, is there an avenue for the individual investor to sue them for fraud?
No. I don't think there's any point in elaborating on it. I mean, emotionally, I can understand. I take the point, but no. I mean, not only that, but if J.P. Morgan's bullion dealing desk was caught out and charged with spoofing fraud, and senior executives actually went to jail on it. And J.P. Morgan were fined quite heavily. I mean, certainly heavily in our terms. But actually, I don't think there's a cat in hell's chance of anyone, successfully suing them. I mean, you could sort of go to Texas, where they historically have been quite prepared to entertain this sort of thing. But would you ever collect? No, I don't think so.
All right. Next question from Sebastian says, you said, and I quote, 100 kilograms of silver will make you feel rich. I think you were probably forecasting a time to come in which the value of silver will be recognized better than it has been the last decade. He said, so I did, and I don't feel rich yet. Can you expand?
Well, I'm very sorry about that. I don't actually remember saying that, but if I did, then I did. I mean, silver basically, once gold starts running, you'll find that silver runs approximately twice as fast. The problem with silver is that when gold is not running, I mean, gold can be moving sideways, then the price can decline. And we've seen this. I mean, we saw silver running back down to 22, 21 something, having been up to 26 when gold first hit that high at, I think, 2070 in August 2020. It's a difficult one. I think the problem also with silver is that no central bank regards silver as a monetary metal for the purposes of its reserves. It is an industrial metal. Now, I would argue that as an industrial metal, it's actually got enormous qualities. And on that basis, I would think that the price here is too low. But the relationship in the paper markets is quite simple. When gold starts running higher, silver runs almost twice as fast on average. So now that we see that gold is breaking out into the upside, we're talking about the price of it in dollars, then on that basis, I think we could well see that silver might catch up and run back up to that $26 level. So hopefully you'll feel a little bit more wealthy as a result of this.
We have a question from Billy Boy who says, what are the prospects for gold mining stocks?
I think that's a fascinating thing because I think the prospects are extremely good. They are so out of fashion to be ridiculous. I mean, we've had gold sort of knocking on the 2000 level, and now, that's certainly support, and arguably even 2100 is now support. And what have gold mines done? Very, very little. I mean, the HUI index, I see it here as 220, having been down to something like 198. I mean, okay, it's up 4.5% today, but this is, it is crazy. In terms of stock market valuations, of course, all the fashion is with the tech stocks. And the result is that mining stocks are just completely ignored. Not only that, but they have been out of favor for so long that mainstream investment managers actually haven't got a clue how to value them. So they really are lagging behind the curve. And my personal view is that it'd be worthwhile looking at, the sort of, if you like, the majors. I mean, just go for safety. You don't need to be terribly clever. Don't start going for 10 baggers and 20 baggers, which, if you're going to play that game, you have got to know a lot about geology. You've also got to know the management. You have got to have been moving in those circles for some time. You've got to be someone like Rick Rule to do that successfully. Otherwise, there is a big risk you come a cropper. So just go for the majors. And I think I would say that they look terribly undervalued to me.
Two more questions. One from Chill034. If all fiat currencies like the dollar just evaporated and disappeared at the snap of a finger, how would wealth be defined? Commodities, ability to perform work, etc.? That's a very sensible question, because we value everything in credit. Credit has become detached from gold, so you can't say that there's a gold standard by which you can measure the value of your property or your bonds or whatever. If credit becomes valueless, then there is absolutely no basis for valuing property, for valuing credit itself, because the other side of credit is debt. Issue debt. You've got to. Someone has an obligation to pay you something in the future, and under whatever terms. If that goes valueless, then you've lost everything, and that is the bulk. Actually, if you look at financial investments, we're looking around the world at about 150 trillion equivalent. That's the estimate that I've seen, anyway. And that would be substantially wiped out. I don't think that credit will go down to zero. I don't see that. But what I do see is I see credit falling very, very hard. The speed of it could be surprising, but we wait to see how events turn out. But I think you'll still be able to use credit as a means of exchange, and by credit I mean currency. I would guess also bank deposits. So you'll be able to do bank transfers. Why? Because it is a primary function of a central bank to ensure that commercial banks don't go bust. So they are fully aware that if people can't trust deposit accounts or deposits at the banks, then the whole system basically blows up. So they will rescue everything, so the cost of it all goes on to the currency. And it's in Venezuela, I can't remember what the currency is, but in spite of the fact that it takes a wheelbarrow to buy a loaf of bread or something, it's still being used, as far as I can see. They are using other currencies. I guess the dollar is probably used a lot, rather like it has been in Argentina. One last pair of questions that are both on the same gist. One says, how safe would private vaults be for metals over a great reset? The others is, will private vaults be safe from confiscation of our precious metals in jurisdictions such as Zurich? Thanks.
And this goes to the heart of the importance of property rights. I understand, and this is what I've read, that there's a situation in California where the feds, sort of, if you like, went into a bank's vaults, whether it was a bank or whatever, I'm not too sure, and confiscated all the property in it. If that is true, that is absolutely appalling. And the point behind the question is that it is not secure to put your gold, your silver, into a safe deposit box because the feds can open it. Now, in this country, we have very strong property rights. But if the police get a court order to open your box, then they can get a court order. So they just have to go through that administrative hoop. Now, admittedly, they do have to convince a magistrate or a judge to issue the court order. But having said that, they're in a very strong position to persuade a magistrate or a judge to do so. And of course, this is why James Turk set up gold money, because he saw that this was a problem. And, when things really cut up rough on the monetary side, on the currency side, then, people are going to be very, very concerned that there might be a confiscation of gold and silver. And under those circumstances, a safe deposit box in private safe deposit box, could well be raided. So this is why James set up gold money, and it gives the facility for anyone to save or store their gold and silver on a custodial basis in a foreign country. Switzerland is a very good question. I would say that Switzerland is generally safe. But having said that, there have been too many examples of the Swiss taking a pragmatic view when it comes to the relationship with US citizens. I think probably a better alternative, or sort of maybe spread it around a bit, perhaps go to Singapore, look at Singapore, because they haven't they don't basically buy into what we're doing. It's turned out to be really quite a secure place. It's based on English law, and when the European Union started and the OECD started bringing in rules which made it very, very hard for anyone using an offshore center to retain their privacy. Singapore didn't go along with it. They retained their privacy. So that's, there are faults there. The other thing I would say for American citizens, be careful that you don't pick a vault storer which is owned by an American company, because there could be an executive order which forces American companies to, divulge any gold or silver, any metal that they actually hold on behalf of US citizens. So that's another aspect which I would take into account.
Well, Alasdair, we always are grateful for your deep experience shared with me and with our viewers and our subscribers. If people want to follow your writing on an ongoing basis, where do they get connected?
Well, I'm head of research at Gold Money, but I'm now writing my own Substack channel, which is either Macleod Finance Substack, that will find it, or AlasdairMacleod.substack, that will also find it. So the research that I was doing, mainly for Gold Money, has now shifted onto there. My market reports I still publish in full on Gold Money's site. The reason I made this move was because I anticipated that things were getting really rather hot in terms of the bad news on currencies, geopolitics, and the consequence is that there was a need to explain to a wider public what gold is about, how it actually protects you. Have some coin, just tuck it away. Don't tell anyone you've got it, for goodness sake. Have something in a foreign vault, which where the property rights are strong. That way you will survive a credit crisis, because we're looking at a banking system which, apart from anything else, is in dire straits. I mean, it really is. All the central banks are technically bust. And as well as that, the major banks are very highly leveraged and cannot take the hit of non-performing loans. Look at the CREs, the commercial real estate. I was reading somewhere that I think it was a Canadian pension fund or something, sold a tower block for $1. The trouble is that if you've got nobody staying in these tower blocks and the debt costs, the financing costs have shot up, you just want to get rid of it. I mean, they're valueless, which has implications, because that wipes out, I think, slightly over half the total equity in the US banking system. And that's just one aspect of lending.
Alasdair, we're always grateful for your presence. Thank you so much for joining us on Liberty and Finance, and we look forward to our next visit with you as soon as we can get our schedules to align again, and thanks for joining us.
That's very much my pleasure. Thank you for having me.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for March 4th through March 11th, 2024, while supplies last. First, we feature backdated 1-ounce silver maples at $3.39 over spot. We also have circulated British gold Queen Elizabeth sovereigns at $26.99 over melt. And finally, we're offering our choice 1-ounce Palladium bars at just $119 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.